Jonathan Millar is a senior economist at Barclays and joins us now. And I want to be clear because talking about an AI bubble is kind of all the rage, Jonathan. That's not what this is, correct?
No, that's not our point here. Our point is a much more technical one with regard to GDP growth and the impetus that comes from AI. And our point is basically that even though the AI spending at this point looks very impressive and has grown, by many measures exponentially over the last year, really, we're probably at the peak now in terms of what this means in terms of contributions to annualized GDP growth. And that's important because really AI, for that to continue to have a measurable impact on the economy, since it's a relatively small part of a $30 trillion economy, you really need it to continue to grow very fast to continue to provide the kind of thrust to GDP growth that it has so far this year.
Yeah, and what you write, and it's an excellent note, Jonathan, what you write, and you'll forgive me, I'm going to look down so I can read your note, is that you said simple math basically shows the capital deepening by itself unlikely to move the needle significantly. You've got to permanently boost productivity, but not just boost productivity. Talk to us about how much we need to boost productivity, basically just to make all this capital spending break even.
Well, I don't know about in terms of how it would break even in terms of market returns. One thing that I can say in terms of having a measurable impact on potential GDP growth, the bar is actually very high if we're looking for that to occur just through capital spending on AI. So to give you a sense of it, we calculate that that you'd probably have to raise the level of investment by about 20% per year in perpetuity in the overall BFI for the U.S. To achieve maybe a percentage point increase in potential GDP growth. Those are really big numbers. I think the only thing comparable to that we've ever seen would be during the 1990s when we saw 12% growth in BFI for about 7 years. In that case, yes, it did move the needle a lot. We had a productivity miracle. But in this case, if that's happening, we're still in the very early stages of it, and we'd have to have growth really pick up in terms of business investment for that to occur.
Yeah, BFI, business fixed investment. And by the way, actually yesterday on this very program, Jonathan, I kind of semi-compared OpenAI to Global Crossing, not with the outcome. I want to be very, very clear on that, but about the need to build out the infrastructure that we now still use. And a lot of what we're doing now, the power generation alone, even if it doesn't go to data centers, we're going to need for the nation over the next 30 to 50 years. In fact, we talk a lot more about this with our next guest after you. But again, whenever there's a relationship to the 90s, it kind of has a weird take. You understand what I'm going for, because the 90s were amazing, but didn't end well.
Yeah, that didn't end well, and we'll have to see whether this particular episode ends well. But one thing that we can say that the 1990s were great in terms of productivity, even though we had a boom and bust cycle in terms of wages, in terms of productivity of the economy. That was a great decade. But really, the issue is here that it's going to be hard to sustain that kind of growth. And I think even when you add in all of this infrastructure, and I think that that's important as well, a lot of people are stressing the fact that we're going to need much more power generation. But even if you look at, say, projections for additional build out of electricity going forward, that's only contributing a little bit to GDP growth as well. So really, I would say just in the very early stages, and if this is going to happen, we would need capex expenditures to be continued to grow at these kind of pace. This kind of pace.
But is that